$200 billion. That's how much one company plans to spend on infrastructure this year alone, more than most countries spend on their entire defense budgets. And the stock is down 18% from its high because the market's not sure it's going to pay off.
When a company bets $200 billion on a thesis, they're either seeing something the market doesn't, or they're building the most expensive mistake in corporate history.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're going deep on Amazon, ticker AMZN, the company that dominates e-commerce, runs the world's largest cloud, and is now making the biggest infrastructure bet in business history. Lana Chen has the numbers.
And these numbers are massive on every dimension.
Amazon is headquartered in Seattle, Washington, founded in 1994 by Jeff Bezos, originally as an online bookstore. Today, it's a 1.5 million employee conglomerate operating across three distinct businesses: retail e-commerce with Prime, cloud computing through AWS, and a rapidly growing advertising platform.
The financial scale is staggering. Trailing 12-month revenue is $718 billion. That makes Amazon the second highest revenue company in the S&P 500. But what's changed the investment story is the mix. AWS generates about 19% of revenue, but over 60% of operating profit. Advertising is now the fastest-growing segment at 22% year over year, hitting $21 billion in Q4 alone.
The competitive landscape is intense. Microsoft Azure is the closest AWS challenger, growing faster at 39% versus AWS's 24%. Google Cloud is number 3. In retail, Walmart is the direct competitor with its omni-channel advantage, and Netflix competes on streaming.
But Amazon's moat is the flywheel. AWS's 28% cloud market share creates enterprise lock-in. Prime's 200 million subscribers create consumer lock-in. And the advertising platform monetizes both sides. Sellers pay to reach buyers, and the margins are extraordinary.
And the timing is remarkable. At GTC and across the industry, the AI infrastructure build-out is accelerating. Amazon just committed $200 billion in 2026 CapEx, outbidding Microsoft's $175 billion. They're betting the company on being the infrastructure layer for the AI era. Andy Jassy has been CEO for about 3 years, taking over from Jeff Bezos in July 2021. But his Amazon career started in 1997, before the IPO. He founded AWS from scratch and grew it from zero to a $45 billion business before becoming CEO.
His background is Harvard College and Harvard Business School. What defines Jassy is that he's both a builder and a disciplinarian. He built the most profitable business unit in Amazon's history, and then, as CEO, executed the largest workforce restructuring in the company's history. He's technical, long-term oriented, and willing to make enormous bets when he sees the demand signal.
The market respects him for AWS. The question is whether the CEO of a cloud business can run the everything store plus a $200 billion infrastructure build-out simultaneously.
Let's get into it. Amazon is trading at $212.79 with a market cap of $2.13 trillion. The 52-week range runs from 161 to 258.60, so we're roughly in the middle of the range, about 18% off the highs.
Valuation?
Trailing PE of 29.6, forward PE of 29. Price to sales is just under 3 times. Those multiples are actually quite reasonable for a company with this growth profile and market position. Historically, Amazon has traded at much higher multiples. The market has repriced it lower because of the CapEx concern.
Revenue picture?
$718 billion trailing, up 14% year over year. Q4 2025 was the standout at $213.4 billion, a beat. The progression shows consistent acceleration through 2025. AWS grew 24%, the fastest in 13 quarters. Advertising grew 22%.
Profitability?
This is where it gets interesting. Gross margin is 50.3%, above 50 for the first time. Operating margin hit 10.8%, up meaningfully from prior years. EPS came in at $7.25 trailing. The margin expansion story is real. AWS leverage and advertising margins are pulling the blended profitability higher.
But free cash flow is the issue.
It is. Operating cash flow was $139 billion, enormous. but capital expenditure was $132 billion, leaving free cash flow at only $11 billion. And that was last year. The 2026 CapEx guidance of $200 billion means free cash flow is likely going negative this year. That's the tension. Massive operating cash generation consumed by even more massive investment.
Balance sheet.
$87 billion in cash against $66 billion in debt, current ratio of 1.12. The balance sheet can handle the spending, but the FCF compression is what's keeping the stock down. Overall, Amazon's financial health is strong. The core businesses are generating exceptional cash flow and margins are expanding. The debate is entirely about whether $200 billion in CapEx will generate returns or destroy value. That's a bet on AI demand, not a bet on Amazon's fundamental business quality.
Analyst picture.
Near unanimous bullish consensus. 64 analysts cover the stock, 58 rate it buy, 4 hold, 0 sells. The average price target is $281, implying 32% upside. Range runs from $175 to $360.
What are the key calls?
The AWS backlog is the headline number, $244 billion, up 40% year over year. That's not future demand, that's contracted revenue waiting to be delivered as capacity comes online. Advertising continues to outperform at 9.4% of total revenue, the highest penetration ever. And operating margins hit 11% in Q4, showing the business model is inflecting toward profitability even during the heaviest investment cycle.
Last earnings?
February 5th, revenue of $213.4 billion, a beat. EPS of $1.95, a slight miss. The miss was attributed to Kuiper satellite launch costs and AI chip R&D spending. The stock dropped about 10% on the CapEx guidance, not on the operating results.
Bull case number 1, the AWS backlog. $244 billion in contracted revenue means AWS will sell every unit of capacity it builds. Jassy said on the call, "We're selling capacity as fast as we can install it." That's the strongest demand signal in cloud computing history.
When demand exceeds supply, pricing power follows.
Number 2, advertising expansion. 22% growth with minimal incremental cost. Prime Video ads, retail media, and programmatic DSP are all early innings. This could become a $100 billion segment within 3 years. Number 3, robotics automation. 750,000 warehouse robots delivering 30% productivity gains, potential savings of $7.5 billion annually. Number 4, Project Kuiper. Amazon's satellite broadband play with 180 satellites deployed and commercial launch in 2026.
Bear case. First, the FTC antitrust trial scheduled for October 2026. The allegation is marketplace monopoly abuse. While a breakup seems unlikely, consent decrees could force changes to seller fees and business practices that impact margins.
Regulatory risk is always hard to price.
Second, capital intensity. $200 billion in CapEx is 27% of revenue. If AWS growth doesn't accelerate, or if AI workload demand disappoints, those assets become expensive anchors. Third, AWS competitive pressure. Azure is growing faster, 39% versus 24%. Microsoft's enterprise bundling strategy is gaining traction. Market share erosion from 28% is a real risk. Fourth, macro exposure. Advertising and retail are cyclical. A recession would hit Amazon harder than pure-play cloud peers.
Let's compare Amazon to the field. We looked at Microsoft, Alphabet, and Walmart.
Microsoft trades at 23 times earnings versus Amazon's 30, a lower multiple with higher revenue growth. Azure is growing faster than AWS, and Microsoft has the enterprise productivity suite, creating stickier cloud relationships. Alphabet at 27 times earnings with similar growth. Google Cloud is distant third, but advertising dominance in search remains unmatched. Walmart at 38 times earnings despite only 6% growth. The premium is for stability, grocery dominance, and the omnichannel moat, no cloud or AI optionality.
So Amazon actually trades at a lower PE than Walmart?
It does, and that tells you how much the market is discounting the CapEx risk.
Options market.
Put-call ratio of 0.95, nearly balanced. IV at the 72nd percentile, which is elevated. Call clusters at 220 and 240, put support at 200 and 190. The options market is pricing in significant volatility. The CapEx debate and antitrust trial are creating uncertainty. but the call positioning above current price suggests net bullish sentiment.
Insiders?
2 buys against 25 sells in Q1 2026. Total net sales of about 12 million. CEO Jassy sold roughly 20,000 shares through a pre-planned 10b5-1. The volume of selling is elevated but consistent with Amazon's equity-heavy compensation structure. Not a bearish signal in isolation, but the ratio is notable.
Key metrics to watch.
3 things. First, AWS revenue growth rate, 24% needs to hold or accelerate as new capacity comes online. Any deceleration below 20 would signal demand is softer than the backlog suggests. Second, operating margin trajectory. 10.8% is the new baseline. If CapEx compresses this below 10, the market punishes. Third, the FTC trial outcome in October. Any restrictions on marketplace fees or seller data usage would directly impact the retail business model.
Lana, bottom line on Amazon.
Amazon is making the biggest infrastructure bet in corporate history, $200 billion, because it sees AI demand that justifies the spend. The core businesses are strong, $718 billion in revenue, expanding margins, and a $244 billion AWS backlog. At 30 times earnings with 32% upside to consensus, the stock is priced for skepticism in a business delivering execution. The key metric is AWS growth acceleration in the back half of 2026 as new capacity comes online. If the demand is real, and the backlog says it is, this reprice is significantly higher.
We'll close with Andy Jassy himself from the Q4 earnings call. He said, AWS is selling capacity as fast as we can install it. Our backlog is at an all-time high of $244 billion.
$244 billion in contracted demand. That's not a forecast, that's a purchase order. The question is whether Amazon can build fast enough to collect it.
That's going to do it for episode 54 of Charged Alpha. Amazon, ticker AMZN. If you found this deep dive valuable, share it with someone investing in big tech. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.